Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, why volatility is the fuel that moves markets, we'll cover our material as well as your questions in a quick 60-minute session. Our presenter today is Bill Ryan, an OIC instructor representing NYSE. Bill started his career in options in 1982 and, in his current role at NYSE, he is responsible for business development and sales for options and new products along with options education. And now, ladies and gentlemen, Bill Ryan will bring you our topic today, why volatility is the fuel that moves markets. Bill?
Thank you, Nick. Welcome, everyone. Thanks for taking time out of your busy day to come and listen to what I have to say. I appreciate it. I'll give you a little bit more of my background. Nick says I started in 1982. I did indeed start in 1982, and I started with a company called E.F. Hutton. So I've always been on the retail side of this business. I worked with E.F. Hutton. I worked with Shearson, Lehman Brothers, S.G. Cowan, and then I went to work for the exchanges. So I've been around for a while. I've been doing presentations for OIC for probably about the last 14 years. It's one of the better parts of my job. I really, truly enjoy being here, and thank you for coming and listening to what I have to say. First thing we have to talk about is our disclaimer. This is what our legal department makes us talk about, and there's several things in here that you should really pay attention to. And the first one is actually in the middle, and it says, in order to simplify computations, commissions, fees, margin interest, and taxes have not been included in the examples. And that's very true. That makes the math easy, but every individual investor knows that you pay commissions when you do a trade, that you have a tax situation. Uncle Sam wants a piece of every time of anything you make money on. So taxes, fees, commissions are very real, and you should know them when you do these calculations at home so that you're aware of what your profit and loss may be. And the second one that's on here is that we tell you that options involve risks are not for everyone. Well, they're not for everyone, but they're for anyone that wants to pay attention to the option world, that needs a set of tools to achieve goals in their investing, and they're a great tool. Not every option strategy works every time, but every option strategy works sometime, and it's a great thing that you're here to learn a little bit more about the options world, and hopefully you'll come away today with a few ideas. Not an expert. We don't expect you to come out of here being an expert, but we do wish that you come out with a few ideas, and somewhere along the line a light bulb goes off and you say, hey, I remember that guy was talking about that the other day on the OIC webinar, and then you do a little bit more research, and it helps you to be a more successful investor. So let's talk about who we are, who OIC is. And OIC is the Options Industry Council. That's the education arm of the OCC, the Options Clearing Corp. Every option that trades on an exchange in the United States clears at OCC. They are the central clearing party, and they are the ones who take the risk out of counterparties. So it's not, the buyer versus the seller. It's the buyer versus OCC, the seller versus OCC. OCC is the middleman. It takes the counterparty risk out. That's one of the things that makes our option business great. The rest of OIC is right here. That's the options exchanges. That's BATS, BOX, the CBOE, International Securities Exchange, MIAX, NASDAQ, and the NYSE. And we're all in this partnership with OCC to form OIC and to go out and educate individual investors on the use of options. And we do this, to make sure that the option world continues to grow and that people have a valid place to get information, an unbiased place to get information. And we do it to make the option business grow. So here's what the option volume looked like a few years ago, quite a few years ago, actually in 1973 when the CBOE opened, and they opened only with calls, right? The volume was very, very, very minuscule. And then you can watch the business grow until you see 1987. We had the crash in 1987, and option business tailed off after that. And then about 1989, 90, the OIC was formed to get investors, to get out there and educate investors and bring investors back into the options markets. You can see that little rise until 2000. 2001, the ISE, the International Securities Exchange, came to be, and they brought all electronic trading, and that increased volume right away. In about 2003 is when I started teaching options, and you can look at the spike that I attribute to myself right there. But you look at this product. It's a great product. It's a young product as compared to a lot of other a lot of other products, equities, and ETF world is newer, but you look at the option world, look at how great the growth is there. It shows you that many people like our product, they're using our product, and are learning how to use our product. Okay, so what we're going to cover tonight, the first thing we'll do is look at a pricing review, basically talk about where option prices come from, then volatility concepts, including historic volatility and implied volatility. We'll look at how we can apply the implied volatility in our trading. We'll talk about a couple of strategies. We'll have some closing thoughts, and hopefully we'll leave 10 or 15 minutes for questions. So if you think of questions as we go, please type them in, and Nick will compile them, and we'll get some of those answered for you before we go home today. All right, so factors that affect an options price, or in other words, where do option prices come from? Well, you take the underlying stock price, strike price, days till expiration, volatility, a risk-free interest rate, and dividends, and you put them into a pricing model. And you put them into that model, and it spits out theoretical values, and it spits out the Greeks. Now, we're not going to talk much about the Greeks tonight. We'll only talk about Vega, which is the volatility Greek. But you put these factors into a pricing model, and you get theoretical values, and you get the Greeks. And anybody that's traded options understands intrinsic value and time value. And while we're not going to actually talk about that tonight, we do talk about the things that affect the time value, not the intrinsic value, the time value. And the things that affect the time value are volatility, the interest rates, and the dividends. And just think about this for a few minutes. The underlying price of the stock is just that. It's the underlying price of the stock. It moves with the market. It moves with the market. It has nothing to do with time. It just moves with the market. The strike price is something we pick and remains stagnant unless we adjust our trade. So that has no effect. Time is what's left. We're paying for time. Time, goes by as the earth revolves. It just keeps going and going. So volatility, interest rates, and dividends affect that time value. They have no effect on intrinsic value. They only affect time value. Now, the last bullet on this slide, in addition to pricing factors, time value is affected by supply and demand. And supply and demand is very real in the option world, and a lot of people don't realize that. But we'll get into a little bit of supply and demand just a little further on in the presentation. So why do we care about volatility? Well, there are a lot of people who will tell you that volatility is the most important thing in an options price. But we're talking about time now, right? We're talking about volatility affecting time. Interest and dividends, that's the cost of money. Time is time, but volatility is the unknown. That's something that we don't know what's going on, and that unknown represents risk, right? Represents risk, and risk in the options world is what drives pricing. Right, so volatility is unknown. It's a key factor affecting an options value, along with the price of the underlying. So volatility represents fluctuation in a stock's price. It's upside, downside. It does not predict direction. It has no idea. Volatility doesn't tell us a stock's going up or a stock's going down. It tells us that a stock can go up and a stock can go down. Remember, it's fluctuation, not a trend. And it can be measured over days, weeks, months, or years. And as a matter of fact, most of what you see when we talk about historic volatility coming forward is or annualized volatility. But remember, it represents fluctuation. It represents movement. And if it represents movement, it represents risk. So we have two stocks here. We have a stock that's charted in a rust color. We have a stock that's charted in a black color in the line. And if these both start at the same price, let's say it's January 1st, they both start the new year at 25, and then the other side all the way on the right is the end of the year, that's December 31st, and they both finish the year at 25. Well, you could look and say, well, this is a pretty steady stock. It started the year at 25, ended the year at 25. But you say that, you don't have what happened in the middle. You don't have a complete picture. When you look at the movement of the stock in the middle, and that's that black line and that rust-colored line going up and going down. That's the movements of the stock in the middle, and that's what the volatility is. What's the movement of the stock from point A to point B? Now, the black line represents a stock that has higher highs and lower lows than the rust-colored line does. That tells you that that stock has more volatility, and therefore it has more risk. And it has more risk because there's more places, more price points where that stock closed over the course of that year. So you couldn't predict from time to time where it was going to land. So the black line, in this case, is the more volatile stock, more prices. The rust-colored line is the less volatile stock. And you have to measure that middle. Beginning and end point don't mean anything without knowing that middle. So we look at this, and you look at the volatility in the marketplace, and you'll often hear when you watch CNBC or CNN or Bloomberg that, XYZ, which is in the pharmaceutical stocks, as a pharmaceutical, dragged down all the pharmaceuticals that day. It was down, it dragged the rest of them with it. And certain industries have certain volatilities that other industries don't have. But the important thing to note is that within a sector, you can have an oil stock that has some volatility and others that have none, a biotech stock that has crazy volatility and another one that has none. Within the sector, they can be different. So it's kind of difficult to just categorize the stocks in a sector and say all the biotech stocks have high volatility, so you should stay away from them. It may be true, it may not, but it's not an absolute that they all are going to have high volatility. Some might be less than others. Usually if you look at the growth stocks traditionally have higher volatility than say, utility stocks. Utility stocks are pretty low. They pay a steady dividend. The stock doesn't fluctuate too much. That might have a lower volatility. If you look at some stocks from years ago, and one that I remember in particular is Taser, if anybody followed that over years ago, that had volatility of over 200 at one point. So different sectors have different volatility, and different stocks in the same sector have different volatility. So we'll talk about historic volatility. Well, historic volatility is what we saw in the past. It happened, it's done, it's recorded. Somebody charted it, somebody put it in a graph. We did the math. It's known. It happened already. That's the historic volatility. And if you look at the little graph that's on the bottom of the slide here, you see that the line's going up and down, and we see where the stock price is closed over a period of time. And usually this is a year period of time. But historic is exactly that. It's what took place already. So, again, what does it tell us? It tells us what it was. It tells us what happened in the past. It's usually calculated on the stock's closing price, but it can be calculated on a midpoint. There are people that will tell you they calculate it on the high of the day. Some will tell you they calculate on the low of the day. That's not an ordinary calculation that I've seen, but I've heard customers tell me they do that. And most times it's annualized. It takes into account a period of a year, but it can be less. There are people who will look at weekly volatility, monthly volatility. I've heard of market makers that calculate intraday volatilities. So when you're looking at volatilities, make sure you know what you're looking at. So if you look at your brokerage house and you get a graph of volatility, maybe you should look around and see what it says. If you can't find it on the web, send somebody an email. Ask them, what do you represent? Do you represent annualized volatility? Is that based on the closing prices of the stock? Is that based on the midpoint of the stock during the course of the day? Is that based on the midpoint of the bid and ask at the close of the day? Ask what they're calculating. Will history repeat itself? How many times have you read or heard that past performance does not guarantee future performance? We hear it all the time, right? We hear it all the time. Just because we returned 9% last year doesn't mean we're going to return 9% this year. It's out there. It's a common phrase in our business. So we look at historic volatility, and we try and make an assumption. And a lot of times we make an assumption that the historic volatility will carry out for the year because we have no real way of knowing what the volatility is going to be. I don't have a crystal ball that I can look at. I don't have a Ouija board there because this is going to happen. So you need a measure. You need something as a starting point to tell you where it's going to be. And a lot of times we look at historic volatility as that starting point for where volatility is going to go. So where do we find it? We find it at brokerage houses. We find it on this websites out there. iVolatility.com is one. ImpliedVolatility.com is another one. OCC has it. A lot of the brokerage houses will have it. So you go and you look at it, and you can do this. You can calculate it yourself if you want, but in my mind that makes no sense. Somebody's doing it for you already. Why would you calculate it again? So you look on different websites. You go to quote services. If you have a Bloomberg on your desk, you're wealthy enough to have a Bloomberg on your desk, you can get it from Bloomberg. There's a lot of services out there that give you historic volatilities. So remember that volatility represents fluctuation up and down. It's a movement. It's not direction. It's movement up or down. Higher volatility tells us that there's a greater range of prices, and a lower volatility tells us that there's a more narrow range of prices. And if that stays the same, we just always figure that as volatility increases, stock volatility increases, put and call prices will increase. And when volatility decreases, put and call prices will decrease. Now, when I say that, think of volatility as the risk. It's risk. And think of an insurance company and trying to price risk. And the example we use all the time in our industry is, the little old lady who drives to church on Sunday, and she's got a very sensible car, and she drives just to church and nowhere else. She's low risk, so she gets, a lower premium. But move her 17-year-old grandson with her, and he sells her a sensible car and buys himself a sports car, and he drives that all over the place. Well, he's a much more risky driver, so her insurance rate goes up. So there's more risk, there's more premium involved. He moves out, he moves back to his parents' house because she kicks him out. The prices come back down again because it's just the little old lady that's driving to church. So her rates will come down, her risk has gone down, her rates will come down again. So you can use that analogy with a stock. If a stock is very risky, you see a lot of price movement. The person assuming the risk on the short side in particular is going to want enough premium to cover that risk. So the riskier the stock, the higher the premium. The lower the risk, the lower the premium. So we measure volatility is actually the annualized standard deviation of a stock's closing prices or daily price changes. So you can look at this and say, we're measuring. This is a measure. It's calculated, and that's what we're going to do. We're going to calculate this and see how widely dispersed the prices are above and below the mean of the stock. So we're going to take a look at that. And like I said, it's usually done over a period of a year, but it can be done for less. And then once again, just a warning that if you're using it, getting it from a broker or a quote service or something like that, make sure you know what they're representing. So here's a little graph. Take a look here. The mean is 50, and we're telling you what a normal distribution is. The prices are the same on both sides of the graph. So if you look, the closing prices go from 45 to 55, with the mean being 50. So they're equally the same on the way up as they are on the way down. All right. So you can look at it that way. So historic volatility looks at that annual standardized deviation, and that's exactly what it is. We use volatility rather than annualized standard deviation in our dealings in the options market. So it's a relative change up or down from the mean of the range of stock prices. And a general rule in statistics is that the prices will close within one standard deviation 68% of the time, within two standard deviations 95% of the time, and within three standard deviations 99% of the time. So, and this is just something for you to know, to keep in the back of your mind. It's not something that you have to memorize, something that you have to, commit to memory because you have to know this every time you look at this. It's just a very general rule for us to go by. So what does all that mean? Well, let's say the closing price of our XYZ stock, the mean was $100, right? That's $100. That's our closing price. That's the mean. So a standard deviation or historic volatility is 25%. So that means that we expect the stock to close within $100, within 25% of the $100, either above or below. So we expect the stock to close at between 75 and 125, 68% of the time. That, right? 68% is one standard deviation. So 68% of the time, the stock will close between 75 and 125. Two standard deviations, 50% means that it will close between 50 and 150, 95% of the time. And three standard deviations is 75, which means that the stock will close between 25 and 175, 99% of the time. Now, if you look at three standard deviations, that's a pretty wide range, right? That's the between 25 and 175. That's a huge number of prices. That's not really very predictive, is it? It doesn't get us down to information that we can use, and that's why we really take a look at the 25%, one standard deviation. That's something more useful to us in most cases than three standard deviations. So here's three stocks. We have stock A with a 15% volatility, stock B with a 25% volatility, and stock C with a 35% volatility. And you look at the graph. See, the stock A is the gray line, right? And you look at how narrow that curve is, how narrow the bell curve is. It's very narrow, very tight range of prices, especially when you compare it to C with the 35% volatility, where the prices are way out. They're way out there. More closing prices, higher volatility, more closing prices. Look at B, stock volatility volatility of 25%. That's kind of in the middle between A and C, right? That's not as few prices as A and not as many prices as C. So you look at this, three different volatilities. Look at the range of closing prices that exist. The higher the volatility, the higher the closing range, the range of closing prices, and the higher the risk involved in that stock. So let's talk about implied volatility. Now, implied volatility is the volatility that gets returned from the current trading of the option. So we have a pricing model, and we put everything into the pricing model. We put the strike price, the stock price, the days till expiration. We put an interest rate, a dividend there. And then we also plug in the price of the call or the put. And we're not plugging the volatility, we're putting the price of the call or the put in. We put that call price in, and it does the calculation. It returns the implied volatility. It's the volatility that comes from the current trading price of the option. Now, it's important that you remember that because it's not the stock. It's the current trading price of the option. Now, what may happen is if an option doesn't trade during the course of the day, a calculator may pick up a midpoint. It may pick up the last. It may pick up the bid. It may pick up the ask, depending on the model that's being used. But when you get implied volatilities, you're getting the volatility that's derived from the current price of the option, not from the underlying stock. So it really reflects the underlying stock's volatility that the marketplace expects going forward, because we're looking at an option, something that's going to expire down the line, something that we use to hope for price movements in the future. So that implied volatility is also forward-looking. It's what we expect of the price, the volatility of the stock to be somewhere out front. So the bottom bullets here, we talk about who ultimately determines option market prices, and it's everybody that makes a bid and ask, puts a bid ask on the screen. It's anybody who trades an option, anything that takes place. It's professionals and individuals alike. It's not one person making that determination. And I think I'm going to make myself a note because I want to come back to this again in a few seconds. I think it's what I want to see a little further, but we'll have to come back to it if I can't find it. So the option prices are determined by individuals as ourselves, putting bids and offers into the marketplace, executing market orders against trades that take place on the screen, as well as institutions and market makers putting their markets on the screens. So again, the implied volatility represents what we're thinking that's happening in the future. Now, remember we said earlier that past performance is no guarantee of future performance, so we can't say that we'll definitely do this. But we need a place to start. We got to figure out how we're going to price this. We don't know, what's going to happen in the future. And if you think about an option, we have an expiration date coming a couple of months from now. Let's just take it one step further. Let's say we're using a leap and we have 2 years to go till expiration. I have to predict volatility out for 2 years. I have to know what my risk is for 2 years. So I have to look at what happened in the past and hope that that's going to help me predict what happened in the future. And I look at what's going on right now, the implieds, and that's telling me what's happening right now. So I have to have some place to go to start to make my calculations. So I use that implied volatility, and it's what gives me an idea of what's going to happen in the future. Now, it doesn't have to happen, and many times the volatility changes. I'm sure many of you out there have heard the term, volatility got crushed, or heard the term volatility spiked. When those things happen, that has effects on option prices. The stock might not do anything, but the volatility may increase and the volatility may decrease. So looking at this and predicting the future is a little bit of a dicey proposition, but it's what we have to do as option traders. So implied volatility is not necessarily the same as stock price. It could be completely different than the stock price. Again, it's prediction of the future stock volatility. It's not really right or really wrong. It's prediction. Time will tell whether it's right or whether it's wrong. And the next section here, we talk about, volatility can occur, changes can occur intraday or over time, abruptly, significantly, doesn't require a change in the stock's price. And this is what I was thinking, what I wanted to explain before. We said implied volatility comes from the trading price of the option, not from the stock. So think about, you're a market maker on the options floor, and you're constantly buying an option. You're buying it, and everybody else is selling it. And then you stop for a second and you say, wow, look at all these options I've bought. I don't want all these options. I don't need all these options. I have to get rid of some of these. So to get rid of these, you have to start selling them. So to sell them, you have to make your prices lower than the best price out there, because you want to be in front of ahead of the guy who had a higher price, because you have all these options that you don't necessarily want anymore. So you lower your price, and then somebody comes in and they trade with your low offer. Well, you just lowered the price of the option. So you just lowered the implied volatility. So it had nothing to do with the stock and everything to do with the position you had on. So you can see that doesn't necessarily have to do anything with the stock. It's just the options trade. And as a market maker, I get myself in a position where I have to adjust. I have to buy or I have to sell to flatten out my risk. And if I do that, I'm forcing option prices to either fall or rise. And when the option price falls or rises, the implied volatility goes up and down, because the implied volatility comes from the current trading price of the option. And this is also the part about supply and demand. The price in the prices of the option. I'm the market maker, and I'm long too many options. I don't want to be long on these options. I have to sell them. So I'm not going to put an attractive bid up there. I don't want to buy anymore. I'm going to lower my bids. I'm going to lower my offers, because I simply want to sell everything that I have. I want somebody else to become the buyer. So supply and demand is affecting my pricing. And when that supply and demand affects my price, it also affects the implied volatility, because I've lowered the prices. Or if I have to buy more, I raise the prices because I have to buy more. And that's going to raise volatility. So hopefully you get the analogies there and you see how that works. So again, will an options, implied volatility return to the stock's volatility level? Not necessarily. It's not safe to assume that it will. We have to have a gauge. We have to have a starting place, and that's what we do. But when you look at volatility, you have to look at it and always remember to check it constantly and look at it and see what's happening, because so many factors are affecting the price of your options that you have to pay attention to this. Now, years ago, when I first started, I said, we didn't have the ability to get volatility. One Bloomberg machine, we couldn't get volatility. We couldn't get the Greeks, but we had people we would call to get them, and those were the smart people, because they had the machines that could calculate volatility for them. So they were the right ones. They were the people to talk to. Now, that change in volatility, that can explain an unknown price change in your option. And you heard me mention a volatility spike or a volatility crush before. And you could be looking at your option price, and it's staying steady at a certain price. All of a sudden, the next thing you know, the price is up really high. Like, what happened here? Well, somebody came in. If some customer comes in and wants to buy, 5,000 options, the person who has to sell it has to assume risk on 5,000. Let's say the calls has to assume the risk of 5,000 calls. That's a lot of risk. So they're going to raise their price before they sell 5,000. They're certainly not going to sell 5,000 at the same price they would sell 10 or 50 contracts. So they raise their price. When they raise their price, they raise the volatility. And that's what happens. And you're sitting on the sidelines and you're watching this, and all of a sudden, bang, the price of your option has changed significantly. And that's because somebody changed the volatility in their model based on the risk that they're going to have to assume soon. So again, we tell you here that as implied volatility increases, call and put prices increase. As implied volatility decreases, call and put prices decrease. And it's not something that happens steadily over a period of time. It can happen steadily. It can happen quickly, as we said before. Just know that if volatility increases, risk increases, right? The young driver comes into the house. When risk increases, volatility increases, prices increase. When risk decreases, volatility decreases, prices decrease. It's as simple as that. Rising volatility doesn't mean the stock is going down. It just means that there's more risk. Declining volatility doesn't mean that the stock is going up. It just means that there's less risk. All right, so an example of what happens when volatility changes. We have an example here where we're buying XYZ December 50 call. We pay $3, and our stock is trading at 50. We have 60 days to go to expiration. So the next day, XYZ fluctuates. It's kind of up and down. It's trading at 45, 46, 47, 48, 49, 50, 51, 2, 3, 4, 5, 53, 52, 50, 48, 50. It travels around up and down above that 50 level, and at the end of the day, it settles at 50. Right? So it started the day 50, it settles at 50, but it's been kind of going up and down during the course of the day. Well, the 50 call went from $3 to $3.40. Well, the stock is where it started. It ended the day where it started, but it's all that price fluctuation in the middle that drove that price change in the option. there was more risk suddenly in that stock. There's more risk. Where is the stock going to close? Is it going to be above 50 or below 50 or at 50? So there's more risk in the price. There's more price points. There's more risk. There's more volatility. The price of the option goes up. It goes up to 340. And we show you here in the example that, the implied volatility level was 35 when we bought it. It increased to 40 the next day. So we have an unrealized profit. The value of our option is now up at $3.40, versus $3. But as we tell you in the bottom, if you wrote this call, you wouldn't be so happy, right? Because when you sell something, you want the prices to decrease. So we bought something, we want prices to increase. If we sell it, we want prices to decrease. Okay, so we talked about most of what we see on the screen here, so there's no reason to go over all of this again. Just that historic volatility is historic. The implied volatility is what is derived from the marketplace, or it's the expected future volatility, what we think is going to happen. And one standard deviation is something that happens about 68% of the time. We're going to look a little bit into the future here, and we're saying that XYZ is trading at 80. The volatility is 30. That's a 30% implied volatility. One standard deviation would represent 30% of 80. That would be $24. So over the next year, with one standard deviation, you can expect $24 movement in the stock, and the trading range would be between 56 and 104, 68% of the time. And it just comes down to the bottom to the three standard deviations. That's 72. We can expect the stock to trade between 8 and 152 99% of the time. And as I said earlier, that's really not a good indicator of where the stock is going to close today or tomorrow. That's a huge price range. But that 68%, with a range between 56 and 104, that's a little tighter. It's a little bit better than 8 and 152. Now, before we move on to the impact of changing volatility, I'm going to roll back a second here and tell you that this is annualized. This can be calculated down to a month, a week, a day, and some brokerage houses will show you those graphs. So it might be more useful if you were doing something for a month to look at the past month, not the past year. So that's something you have to consider when you look at a volatility chart and see what it is. And I'm doing a weekly option. Well, I don't know that I'm so interested in what happened last December. I might be more interested in what happened last week, or 2 weeks ago. So I think I'd like to look at what the volatility is for only a week time period, not a year time period. We don't show you that here, but just telling you that is available on a brokerage houses and may be more useful to pair your volatility calculation to a time frame that is closer to what you're trading rather than a year. So we talked about the Greeks earlier, right? We put in a pricing model, we get the Greeks, and one of the Greeks is Vega. And Vega is the Greek that tells us what we can expect to happen to an options price for a 1% change in the volatility. So for anybody that's not aware of the Greeks are kind of like the dashboard of your car. You're driving along your car and the yellow check engine light pops up. Well, when that pops up, that tells you that something is going to happen. You got to get your car to the dealer or to a mechanic because something isn't quite right. It doesn't mean stop immediately, pull over, don't drive your car. It simply means that something is going to happen. It's a warning. It's a light that says, hey, something's going to happen here. Get this checked out before you go any further. Now, you could look at the Greeks the same way. We look at delta, gamma, theta, vega, and rho, and they give us ideas about what's going to happen. And the same with the volatility. The volatility is that Greek that says, "Hey, this is what's going to happen to your option price." And if you expect volatility to change in this option, you're going to watch this happen to your option price. Now, that could mean that it's good. I want volatility to increase because I want my price to go up. I want volatility to decrease because I want my price to go down. I want my naked options or my short options to expire worthless. But it just tells you that something is going to happen. And it gives you a little measure of what's going to happen. So you see on the bottom, it says, how does it work? Implied volatility, implied up 1 point equals call and put prices up by the Vega amount. So we'll show you the next example, which is our June 60 calls or puts doesn't make a difference here. They're trading at $5 and the current volatility is 50 and our Vega is 15. So if the stock goes from 50 to 51, a 1-point move, we expect the option price to change by 15 cents. So you see the option price go from 5, a 15-cent change to $5.15. If the volatility went down from 50 to 49, we can expect the price to decrease by 15 cents. So if it does that, we watch the call put go from 50 cents to $4.85. So you can see how that acts as an indicator of what's going to happen or what may happen in the future. So it's a good thing to keep your eye on the Vega. It just tells you if there's a big move, if volatility is 20 and there's a 1% move, it's 20 cents is going to happen. If volatility is 80 or 85, a 1% move equals 85 cents or $85. It's a big thing to pay attention to this. You watch this, it gives you an indication of what is going to happen. You can see that there's cash risk involved. It's very important to pay attention. It's a big factor in options pricing. The stock doesn't move if volatility changes. Your option prices are going to change. It is entirely theoretical. It's out there. It's math. It's something that you pay attention to. Vega decreases with time. As time passes, there's less opportunity something happens. So volatility is going to be lower. We tell you the stock has zero Vega. It has zero Vega, and Vega can be netted with complex positions. So anybody that's out there that likes to do spreads, you have a long and a short, that Vega nets. The long and short Vega nets. So if you buy something with a 30 Vega, you sell something with a 20 Vega, you have a 10 Vega position left. It nets out. So that's another thing that's good to know when you're doing spreads, that you can net these. All right, so let's talk about a couple of strategies here. So remember what we said at the beginning of the webinar, that at expiration, an option is only worth its intrinsic value. Time is gone. There's nothing else that can happen. It's gone. It's over. It's only worth its intrinsic value, nothing else. Now, we get into discussions all the time when we do live seminars about, what happens with an option at expiration, what happens in the middle. So at expiration, an option is only worth its intrinsic value. But during the life of the option can have no intrinsic value, but will have time value. And the time value, again, a big part of that is the volatility, because it's what we think is going to happen, not what happened, not what happened yesterday, not what happened last year, but what we think is going to happen for the next period of time, whether it's a week that we own the option, a month, 2 months, 6 months, it doesn't matter. It's what we expect to happen. So volatility plays a big part in that pricing before expiration. So you may hear a lot of times, you've heard me say numerous times, that an option is only worth intrinsic value at expiration. But there is money to be made before expiration, and the money is to be made before expiration. A lot of that is because of volatility. So the bottom half is we tell you that changes in implied might lead you to exit the market early. For example, I buy an option with a volatility of 25, and then all of a sudden the volatility spikes up because there's anticipation of some great product coming out, and the option stock price hasn't changed yet, but there's talk on the street, there's this going on. CNBC has a special report, and the volatility in the option world spikes up. Well, my option will be worth more. Well, maybe rather than waiting for the actual announcement or waiting for the stock to go, waiting for to follow the trend of the stock over a period of time, I just sell my option now because I got the spike. I achieved the goal, which is what for the stock, the price of the options go up so I can make money. I've achieved that goal, and I'm exiting now before I was originally planning on. It could also allow you to get out earlier. If you're short a position, volatility jumps and you're losing money. If you're long a position and volatility collapses and you start losing money, you may decide, okay, this is the time to get out. Now, remember, this is all about planning too. Successful option traders manage their risk and their reward. And if they see that risk is changing because volatility is changing, and they thought they had more time left, they may close earlier because, I think I have more time left on my option, but I don't like this the way this is going. This implied volatility is predicting this is going to happen. I'm going to close now. So it helps you make a decision. It's not a decision maker, but it certainly helps you make the decision. So most people don't realize it, but anytime you buy a call or a put, you're hoping for volatility to increase. Because as volatility increases, stock prices increase. Most people that buy a call are hoping for an increase in the stock's price. And it's a nice surprise when a volatility increases and the price of their option goes up. But when you buy a call or put, a long position like that, you're looking for the implied volatility to increase. If it drops and prices go down, you're going to lose some money. Right? The exact opposite with the short side. If you're short a call or a put, you're expecting, you want the stock to drop or go up with, depending on the call or the put, but you're expecting some movement in the stock. If volatility comes down, those prices are going to come down. And if they come down far enough, you're going to be able to buy that option back for less money than you sold it, and you're going to make money. Now, if the implied increases, of course, the stock prices go up. The option prices go up, you're going to lose some money. And again, this is also something that can be netted with spreads. So when we think about this for a second, if I'm thinking about buying a call, and I look at the volatility, and the volatility is 75. I have to look at that and say, it's 75. How high is this volatility going to go? Because if it comes down, the prices are coming down. So I have to think for a second. Well, where is volatility usually? So I'll go back to a chart and I'll look and I'll say the volatility is usually 50. If this does return from 75 to 50, the prices are coming down. I can't possibly make any money here. So maybe if you look at that, it may make you decide not to actually buy that call because implied volatility is very high compared to historic volatility, and it may make you decide not to do that because it's too high, and if it comes down, you're going to lose money. So it's just another way of looking at it, just another thing to think about when you're looking at volatility and looking at your trading. Strategies that want implied volatilities up, well, for long straddles and strangles, we're buying two sides, right? We want an increase in volatility. A lot of people say, I buy a long straddle. I hope the stock, I'm looking for a huge price movement in the stock, either up or down. But what you're really hoping for is volatility. You're hoping for volatility to change because that's going to drive both of your prices up. If you do a straddle and the stock goes up, the call goes up, the put goes down. If the stock goes down, the put goes up, the call goes down. But if volatility increases, both sides go up. So you're really looking for both sides to go up. You don't need a huge movement, a huge increase in volatility. A little one is going to move both sides, and therefore you can make money. Back spreads, you're buying more options than you're selling. You want increases because you want increase in volatility because you want the greater position to increase rather than the short side increase. But all these positions carry risk just like any options trade does. Implied volatility go down. Let's sell the straddle, sell the strangle. Now, selling straddles and strangles is very risky to begin with. Your short calls and your short puts. Short calls carry unlimited risk. Short puts carry substantial risk. But what you're looking for, again, is for prices to come down. You've looked at volatility. Volatility looks unusually high. You think there's some kind of news out there pending. When the news comes out, everybody's going to be happy because the news is out. The uncertainty is gone. It's going to be so-so news. It's not going to push the stock one way or the other. So we want the volatility to come down to bring those prices back down again. And that's the same thing with ratio spreads. You're selling more options than you're buying. So you want this volatility to come down because you'll make more on the options that you sold than you will lose on the options that you bought. Now, again, we have short straddles and short strangles up here, not something that we usually talk about. Just to remind you one more time that short calls and short puts carry substantial risk. Short calls, unlimited risk. Short puts, substantial risk. All right, so in conclusion, you don't need to know, you don't have to have a thorough knowledge of math and stats to understand volatility. If you like to calculate this stuff, do it on your own. If you're a math guy or a math gal, you love to do it, by all means go out and do it, but you don't have to do it. And the average investor doesn't have the advanced math degree, and the average investor can look at volatility on the screen and see how they're doing. They can learn the concept behind it. Volatility up, prices up. Volatility down, prices down. Volatility for the option is not the same as volatility for the stock. The more you understand about volatility, the more you understand how it's going to affect your prices. Think about Vega. That's that dashboard again. I'm looking at the Vega, and the Vega says the volatility is 95. I go, oh, geez, what's going to happen if my stock goes up or goes down, it's going to have a huge impact on my position. Volatility is, Vega's 20. I mean, well, it's not going to have that much of an impact. You have to look at that and understand how that affects your option prices. So that, a good understanding helps you pick the strategies that you want. It helps you understand what's going to happen going forward. It sets your expectations of what's going to happen, so there'll be no surprises. So that's all we had for today. Here's some information for you here. If you need more information, go to our mobile app, OIC's mobile app. We have a YouTube channel. You can look at that. Or go to www.optionseducation.org. That's a great resource. You'll find everything from what's a put, what's a call, to spreads, straddles, strangles, volatility, synthetic positions, back spreads, call spreads, you name it, it's on there. Butterflies, condors, iron butterflies, iron condors. Enough stuff there to keep you busy for about a year. Again, thanks for taking time in your day to be here and listen to me. And I think Nick is going to tell me if we have any questions.
Bill, we indeed do have a couple questions, but before we get to those, I want to remind our listeners that if they have further questions about the concepts we talked about today, or were not able to get to the question that you submitted, you can always contact the Investor Services team at options@theocc.com, THEOCC.com. They're ready to help answer your questions about options strategies or positions. And Bill, I'm glad you mentioned the Options Industry Council website. That's an invaluable source for information, optionseducation.org right there. And our older webinars are available on the OIC YouTube channel. You can check those out at your own pace. Bill, let's start with one of the basic questions. I think we got this a number of times, and I think we've got some people who are new to the concept of volatility. Let's talk about volatility versus underlying price. What's going to be more important, or is there a way to make a determination there?
All right, that's a great question, and a lot of people who aren't used to watching volatility get confused, and they wonder which they should pay attention to. And as I said, part of the presentation, at expiration, it's the underlying price of the stock. There is no volatility anymore. It's the price of the stock at expiration. But before we get to expiration, there's many things that affect options, and volatility is the biggest one of all of them. If you heard me say a million times, if volatility goes up, the prices are going to go up. So we could have a stock, an option on a stock that's just kind of laying low doing nothing. And then, the rumor gets out that they've invented the next best thing since, the Apple Watch, and rumor gets out and the guys on the floor are getting all antsy and volatility is starting to change, and that's going to jack the price of your stock up. So volatility is very much a part of the process, and it can be as important, if not more important, before expiration than the underlying price of the stock.
So we have a number of people that are looking to figure out what the best place to go for information for either implied or historical volatility would be. The people have said that they have a brokerage that has a volatility calculator and they like that, but then they look somewhere else and they see a different number. Is it worthwhile to try to figure out what your own volatilities are? What's the best way to approach that?
Well, Nick, I don't know that I would tell anybody to calculate their own volatilities. There's a lot of them that are out there, and there's a lot of discount brokers that offer this. So what you really have to do is go to a couple of different websites and try out a couple of pricing calculators, see what the brokerage houses offer. Send an email, ask them how they calculate the volatilities. Are they all annualized? Do they offer a month or a week? Are they using the closing price of the stock? If the stock doesn't trade, do they use a bid or an ask or a midpoint? So there's questions that you have to ask, and I liken it to driving a car. A lot of people can't build a car, but they go find a model they like, and that's the one they drive. So it's the same thing with volatility calculations. Find the model that you like, do a little research, and that's the one that you use.
Let's follow up on that question a little bit. People were saying that they're actually also seeing differing prices. Their brokerage might say one thing, an online options calculator might say another thing. Why are we seeing that difference in pricing?
Well, the difference in pricing could be attributed to different volatilities. So, for example, if I see a price on a screen that looks high to me, I look at a price and I see it's a call is offered at $3, and that looks kind of high to me, and I think it should only be offered at $2. Well, I go to my calculator that I have for my brokerage house, and I plug all my numbers in, and I still get $2. But I have to look and figure out where they're getting this volatility from. So I kind of do a little bit of reverse engineering here, and instead of plugging the volatility in, I plug the price of the call in, and it gives me the return, turns the implied volatility. And I look and I see their implied volatility is much higher or much lower than what I have. So something has to be wrong here. And, it kind of comes down to, if everybody else is different than you, you are probably wrong. And if you're wrong, it means that you're not understanding something or you're putting something wrong into the model, and that gives you pause to think before you actually do this trade. If you don't agree with everybody else within a certain distance, I'm not saying everybody has to be exactly the same, but if you're dollars off what somebody else is offering, something is wrong, and it's either something you're doing or they're doing, and if all of them are the same, then it's you. So it's time to take a step back, look at what you put into the model. Maybe you put a different time in. Maybe you put you put a too low or too high a volatility in. Maybe you're actually just comparing the wrong strike price by mistake, but it's a warning to take a look and do your research a little bit further.
Bill, we got a question here from, I think, one of our more new level investors, and we also have some from some advanced level investors, but let's start with the new question first. This investor wanted to know that he's been trading options for a few years, but really hasn't paid attention to this concept of volatility. Heard about it, not really sure what to do with it. What's the best argument to use as to why you should start using volatility?
Well, in my mind, it goes back to the dashboard scenario. Every time that I look at a trade and I think something's going to help me make a decision, I like that. This helps you make a decision. It helps you look a little bit into the future and say, if this happens, then this will happen. So it takes a lot of the surprise out of it. Now, it doesn't take it all out completely because there are many things that we can't control and many things that happen that surprise all of us. But it just gives you another idea, something else to look at, something to help you make your decision. So I think looking at volatilities before you do the trade is a good idea. And if you look at it and it looks too high, look at the volatility. And if the volatility comes in at 200, well, even not even knowing what the stock is, not even knowing what my calculation is, I know 200 is something that I do not want to play with. So I will just skip that one altogether and move on to something else. It's a piece of data that helps you make your decision.
Bill, let's take a slight detour and talk a little bit about Greeks as they pertain to volatility. Obviously, Vega is directly related to volatility. Talk a little bit about Vega. You mentioned that during your presentation, but also then go into the concept of the other Greeks. What's going to be important to look at, delta, gamma, theta, when you're looking at a trade's volatility?
All right, so I'm going to kind of answer that question backwards. When I look at doing a trade, I pay attention to delta, I pay attention to Vega, and I pay attention to theta. I ignore gamma. Gamma is something that a lot of professional traders use. I am not a professional trader. And I ignore rho because rho is the measurement that shows you the effect of interest rates on your option price. And with interest rates as low as they are now and as low as they've been, I don't think that's something that I have to worry about in the near future. But delta is going to tell me what I expect the options price change to be for every dollar the stock changes. That's important to me. As the stock goes up, how much money am I going to make? As the stock goes down, how much money am I going to lose? So that helps me there. Delta helps me there. Theta tells me what happens as time goes by. And time just goes by. Time just keeps on rolling. You can't stop time, right? So every day, if nothing else happens and I'm long an option, how much money am I losing? Or every day, if nothing else happens and I'm short, how much money am I making? So that gives me an indication of how well I'm doing with my long or my short. And then Vega tells me, first of all, whether I should be involved in this option or not. As I said, a few minutes ago, if Vega looks too high, not something that I'm, me personally, that I'm prepared to deal with. An individual investor may be prepared to deal with high volatility and may actually like high volatility because of the price swings. So that may be what they're looking for. But when I see a high volatility like that, I often think that this is something that I don't need to be involved in. I don't want to be involved in. I'll find something else to do. Now, there are also investors that will look at volatility and say, hey, that volatility is kind of high. I think that's coming back down. So I'm changing my mind now. Instead of buying that option, I'm going to sell that option because when the volatility comes in, I will make money. So again, volatility helps you make a decision. Delta and theta also help you make decisions, and they also help you set expectations for the future.
Bill, this investor wrote in and noted that when volatility is rising, he's usually seeing the bid-ask spread increasing as well. Is there anything you can do to mitigate that?
So the bid-ask spreads will change. Some of the more liquid and more actively traded options, it won't change that much. But if you see volatility increasing and bid-ask spreads widening, you can look. That's an opportunity to try and get in the middle. If you look at something that's a penny wide, you can't get in the middle. 2 cents wide, you only have one place to get in the middle. Something that's 6 cents wide, you got 4 price points in the middle that you can work with. So it gives you an opportunity to try and do better than what's on the screen. Just because something is offered at 25 cents doesn't mean you have to trade it at 25 cents. Maybe if you want to buy it, you put your bid at 23 cents. So you can try and get in the middle of those situations. Now, it doesn't always work. I'm sure there's people out there now shaking their heads saying it never works. But there's an ability to get in the middle. It's a place to try.
Thanks, Bill. We're coming right up on our 60-minute stop time, but I think we have time for just one last question here. And this investor wanted to know about covered calls during times of high implied volatility. Is that a good idea? That way you can sell high, and if the volatility drops, you can still buy the option back for less. Is that a strategy that you might consider?
Well, that's a great question, because when you do a covered right, you need a certain amount of volatility to get the premium that you need to make it worth your while to do the buy right. Because when you do that buy right, so let's call it a covered right where you already own the stock or we're going to sell an option, but we're still paying a commission when we sell that option. So we need a certain amount of volatility to get a higher enough price to cover our commission costs and make it worth our while. Now, don't forget, when you sell the covered call, you're selling stock effectively. You may be forced to sell stock at the strike price plus that premium. So the more premium you bring in, the more upside potential you have on that stock. Now, let's just say the volatility is very, very high. So very high tells us price fluctuations. That means you could end up selling your stock. You could end up keeping your stock. So the answer to that is really how comfortable you are selling your stock. If you're not comfortable selling your stock, then don't sell it in a time of very high volatility, because you have a greater chance of being called away and losing that stock. But if you are comfortable losing that stock, maybe that's the opportunity you take to get that premium. And by the way, if it comes back down again, you may get the opportunity again. So it's really a comfort zone question.
Bill, thanks for your expertise today. Do you have any closing words for our attendees?
The only thing I would say is, pay attention to your positions, look at volatility, pay attention to it. Like I said, you don't have to, know how to calculate it. You don't have to be, you don't need a PhD in math to figure it out, but know it, learn it, understand it. Don't get frustrated if you find it difficult in the beginning. It's like a lot of things in the option world. It just takes time to understand it. Basically, increased volatility, increased option prices, decreased volatility, decreased option prices. That's your rule of thumb. And pay attention to the Greeks a little bit, and good luck.
Thanks, Bill. And ladies and gentlemen, thank you as well for your time today. We did have a number of questions we were not able to get to, but we do have our investor services desk ready to help, as I previously mentioned. You can always reach out to them at options@theocc.com. Our webinars are also available on the OIC YouTube channel, so you can review a number of options strategies and concepts at your own pace. Many of your questions also ask about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.